The title of this presentation is "What is the single dominant factor that has driven improvements in profit in South Africa over the last 20 years compared to other countries? And what is South Africa's Achilles heel limiting profit in the future?" The subtext to my presentation is what more needs to be done to confidently establish the industry's international competitiveness and provide a potential platform to becoming an exporting country. Again, I'd like to give a big vote of thanks to Standard Bank and Barrenbrook for making these webinars possible. Our presentation will cover the following. Firstly, confirming the basis for the countries that are being reviewed and compared. Then, what are the trends in production and profitability? Next, what are the South Africa's strengths and weaknesses? I'll describe the dominant factor that drove growth for the last 20 years, and then outline what is the major weakness, or what I've described as the Achilles heel of the industry. Finally, I'll outline what some strategies might be for South Africa to develop a substantial export industry. There are 6 countries with full comparative data in this presentation, with these being South Africa, New Zealand, Australia, Argentina, Uruguay, and the United States. There is some milk production and milk price data for Ireland, though I expect to have more complete data for Ireland in the future as part of some collaborative work I'm doing with Lawrence Chalou, the leading production systems researcher in Ireland, and Mark Neal, Dairy New Zealand's production systems specialist. This presentation is significantly informed from a paper I had published earlier this year in Australasian Agribusiness Perspectives, titled "Evaluating the Loss of Profitability and Declining Milk Production in the Australian Dairy Industry." There is additional data and an addendum available from the Red Sky website that covers ratios and relationships that could not be included in the published paper. Listed here are the data sources for my presentation. All of the national statistics come from the leading government or industry organisation in each country. The farm performance data comes from either the largest or one of the largest data capture organisations in each country. There's more detail on these data sources referenced in my published paper. The South African data is all from pasture-based dairy farms, so it does not represent the feedlot farms in South Africa. If I could get access to some feedlot data, then I'd be keen to include it in this comparison in future. The United States data arguably represents the performance of the best feedlot farming industry in the world. This table categorises the countries in regards to milk market focus, climate, and the level of government support or intervention. New Zealand and Uruguay are the 2 countries with a dominant export focus, with South Africa being the one country with a dominant domestic focus, while the other countries have a mixed focus. New Zealand and Ireland have a cooler temperate climate, while all the balance have a moderate to hot temperate climate, notwithstanding that the US has a full range of climates. All 5 moderate to hot countries have some regions that are subtropical. Most of Australia's dairy industry is more southerly than Argentina, Uruguay, and South Africa, and so it's more favoured for pasture and animal production. 4 of the countries, including South Africa, have little to no government support in their dairy industry, while Argentina, the United States, and Ireland have some significant government intervention in their local market. Most of my slides are going to have a format similar to this one. The countries are listed above the graph, and I've endeavoured to use some portion of national colours for each country. So South Africa is in Springbok green, New Zealand in black, Australia in gold or yellow, the United States in red, Argentina in light blue, Uruguay in dark blue, and Ireland in lighter green. All graphs have the years on the horizontal axis, with this mostly being 2003 through to 2019, though some, like this one, going through to 2020. All milk ratios are in litres, with this milk energy corrected to 4% fat and 3,3% protein to make the comparisons fully relevant. This graph is intended to set some context for the size of the dairy industry in each of the 7 countries. The New Zealand industry is roughly the same size as the combined size of Australia, Argentina, South Africa, and Uruguay. The US industry is roughly 4 times the size of the New Zealand industry, so the US production on this graph is just their export volumes. It can be a little sobering, seeing how much additional milk a country like the US can add to the international trade. This graph highlights the trends in milk production growth rate for each of the 7 countries, where 2003 milk supply for all is set at 1. All countries have been growing milk production except Australia, although some countries like Argentina and Uruguay have seen growth stall at times, especially when poor climatic conditions linked with low milk prices. I believe it's fair to say that all of these countries are experiencing similar challenges in regards to general environmental, societal, processing, marketing, and consumer trends. Farmers in all these countries complain about the unfair practices of supermarkets and big business, how their dairy processors or milk buyers are not efficient enough, and how weather events and potential changes to climate are impacting them. South Africa's growth in milk production is impressive in scale and consistency, as the dark green line highlights. The annual year-on-year growth over the last 18 years has been 3.6%. This is the same graph of milk production growth over the last 18 years, though trend lines have now replaced joining of the annual dots on the previous slide. This highlights how strong the growth has been in South Africa and how weak it has been in my own country of Australia. It also highlights how growth in milk production has accelerated in Ireland once subsidies were removed. Ireland has really focused on maintaining a high percent of pasture in the cow's diet, so that cost of production was low and profit margin was high compared to their European counterparts. Once quotas were removed in Europe, the Irish industry was in a position to profitably expand, as the upward curving light green line highlights. So what has been happening to farm profitability across these countries? And what is driving any changes in profitability? This graph is return on capital on the vertical axis, which is the ratio that defines profit. South Africa in green is the most profitable of the countries by quite a large margin. South Africa beats New Zealand, as land prices in particular, as well as cow prices, are much lower in South Africa. New Zealanders are well known for paying very high prices for land, which does lower their return on capital or return on the value of all assets. Noticeably, Australia, Argentina, and Uruguay all moved from a more competitive position in the early period, often with a higher level of profitability than New Zealand, to being on average in a much poorer position in the latter part of the period. Milk prices significantly lifted in New Zealand, Australia, and the US in 2020, though not in the other 3 countries, resulting in there being the narrowest spread of profitability between the countries in 2020 compared to any other time over the last 18 years. One trend that may be emerging is that South Africa's advantage over all other countries in profitability may be reducing. Once again, this is the same graph as the previous one, though with trend lines added. 3 countries have been increasing profitability: South Africa, along with New Zealand and the US. 3 have been experiencing declines in profitability: Australia, Argentina, and Uruguay. South Africa does look to be in a very strong position, though I do wonder if this might be giving a false sense of security. Please note the R-squared value is just 0.05 for South Africa's return on capital. This quadratic equation for the South African data dramatically improves the fit, increasing the R-squared from 0.05 to 0.39. It's too soon to be confident of the real trend, though there are some factors that would support the notion that this fit represents the more correct trend. This graph has operating profit margin on the vertical axis, which is the percentage of each dollar earned that is retained after all operating expenses are paid. Another way of describing this ratio is that if, say, a farmer had a profit margin of 15%, then they're keeping 15 cents in each dollar that they earn after paying for all expenses, including maintaining their plant and machinery and receiving a salary for the time they work. This leaves the 15 cents in each dollar for paying interest and principal on any loans and for investing within the business or utilizing elsewhere. Although there is a lot of volatility in this ratio, New Zealand is clearly in the strongest position, with South Africa arguably in the next strongest position in recent years. All 4 of the other countries, including the US, have lower operating profit margins, with Australia dropping to the bottom of the pack as time progresses. Operating profit margin is a measure of business or financial risk, and so it is an important assessment of business resilience. The higher the profit margin, the more likely it is that a farm can accommodate a reduction in milk price, an increase in supplement prices, or a poor pasture growing season. Profit per litre is a similar risk ratio to operating profit margin. And the flip side of the coin to profit margin is cost of production, as a lower cost of production increases the profit margin at any given milk price. This is the same operating profit margin with trend lines. This again highlights how New Zealand, South Africa, and the US have been maintaining or increasing profit margin, while the other three countries have been declining. It's important to note the low profit margin for the US, with this being a characteristic of all feedlot production systems. These systems are based on high volumes of milk being produced per cow, often 9,000 to 11,000 litres per cow, with this milk being produced at a comparatively low profit margin. This can still result in high levels of profitability when commodity prices run in the dairy farmer's favour. It can equally result in periods of large losses when commodity prices are unfavourable. This graph has profit per hectare on the vertical axis. All financial results are in US dollars, with local currencies having been converted to US dollars at average exchange rates over the July to June financial year. Again, there was a lot of volatility for all countries, though New Zealand and South Africa have emerged over time as similarly profitable on this measure and in the strongest position by a wide margin. Australia, represented by Victoria, has moved from a competitive position in the early period to the weakest position in the latter period. Victoria represents around 2/3 of the dairy industry in Australia, and it should comfortably beat Argentina and Uruguay on this measure, given pasture harvest is around 50% higher in Victoria. So this really does highlight the terrible position Australian dairying is now in. When trend lines are added, this further accentuates the much stronger position of South Africa and New Zealand compared to the other three pasture-based countries. Again, the only potential concern for South Africa is whether this does represent the underlying trend. Please note the R² value is 0.31. Once again, using a quadratic equation for the South African data significantly improves the fit, increasing the R² value from 0.31 to 0.59. This does raise some concerns for South Africa, in my mind at least. This graph has profit per cow on the vertical axis. Although again, there was lots of volatility for all countries, New Zealand in black is definitely in the strongest position. All the other countries are difficult to separate, other than Australia, which progressively falls to the bottom of the pack. South Africa is certainly not in a strong position on this measure. When trend lines are added, this further highlights a potential weakness that may be emerging. Although Australia is again the poorest performer, all the other countries have a steeper increase than South Africa in their profit trend line. Again, please note the R² value, which is just 0.11. And again, if this quadratic equation for the South African data dramatically improves the fit, increasing the R² value from 0.11 to 0.45. Profit per cow may be emerging as a potential area of weakness for the industry, or at the least a potential opportunity where profit may be able to be improved. So what are the external factors that may be limiting profitability? First is look at milk price, with farmers often complaining about the influence of supermarkets or that milk buyers are not paying a fair price for their milk. This graph has milk price in US cents per litre of energy-corrected milk on the vertical axis. There are a number of interesting factors to highlight here. New Zealand milk price is the most volatile, given that country's almost total reliance on the export market. South Africa in green does have an advantage over all countries except the US and Ireland through to 2011, which is what would have been historically expected given your domestic production focus. So this advantage has disappeared since 2011. The US and Irish milk price is almost always significantly higher than for all the other countries, which may be an initial warning for those advocating pasture-based Southern Hemisphere countries learn from or imitate the US production system. The international market trends are even clearer in this graph when trend lines are added. Where governments do not restrict market access, then milk price is now similar regardless of whether the country is export or domestic focused. For those countries where governments do interfere significantly in the trade of dairy products across their borders, such as the US, Ireland, and the rest of the EU, the premiums being paid to dairy farmers over and above the internationally traded value of milk has significantly decreased, and the difference in price is continuing to narrow. This is an important change for the South African dairy industry, as a significant percentage of the profitability gains over the period from 2000 to 2010 were from a milk price premium over and above internationally traded milk price. And this premium would appear to have now disappeared permanently. The change in the dynamics of internationally traded milk prices coincides with two major changes in international trade. Firstly, the emergence of China as a huge importer of dairy products. And secondly, the emergence of the US as a major exporter of dairy products. None of these comments are intended to explain why the present milk price in South Africa is even lower than in most export-focused countries. What about the impact in recent years of poor weather, drought, or even climate change? Many Australians have been complaining recently about the climate, but what seems unarguable is that the same climate impacts all countries around the world in relatively equal measure over time. So it's best we focus on factors that are within our control if improving profitability is the goal. How about size of farms? Could this be an issue for the South African dairy industry? In reality, size of farm is not generally an issue in pasture-based dairy farming, as there are so few economies of scale. This graph has number of cows in herd on the horizontal axis and return on capital on the vertical axis. The data comes from large data sets of Australian and South African dairy farms, with the Australian data being the more robust. What this highlights is that there was little, if any, impact from farm size on profit, with very small and very large farms tending to have lower profitability than the great majority of moderate-sized farms. This table outlines average farm sizes across the 6 countries, with South Africa having one of the largest average farm sizes internationally, and New Zealand being the only country in this group with somewhat larger farms. Overall, it's clear that farm size is, if anything, an advantage South Africa has compared to other countries. So now let's look at the trends for cost of production, arguably the most important single measure outside return on capital for dairy businesses to monitor. Why? Because maintaining a low cost of production that is competitive with other export-focused countries is essential, especially as the world has become more interconnected. Equally, for most domestic-focused dairy industries that are exposed to imported dairy products, as they need to be able to compete with these products on price. The table outlines how cost of production is calculated, and by deducting livestock revenue and any other non-milk revenue from total expenses, this allows the cost of production, 308 cents per litre in this instance, to be compared directly to milk price at 454 cents per litre, with the difference being the profit margin of 146 cents per litre. You can see in this graph that South Africa in green has moved from having the second highest cost of production after the US in the early period to having the second lowest cost of production after New Zealand in the latter period. The United States in red has a substantially high cost of production throughout the entire period, which might make some of you wonder why so many farmers in pasture-based countries have been adopting US-type production systems. It would be interesting to know where South African feedlot farmers are positioned on this graph. Once trend lines are added, it is clearer how good the performance of South African farmers has been. To further highlight the international comparisons, I've added the table with compound annual growth rate or year-on-year increases in cost of production for the 6 countries. South Africa's performance is exceptional, with just 2.3% year-on-year increase, with the US and New Zealand the other top performers. The other 3 countries have all had higher increases in cost of production. and it is these three countries that have all at some point stopped growing their milk production. This graph outlines the economic cost of production as opposed to the more commonly used accounting cost of production. Economic cost of production is calculated by adding a cost of capital to the accounting cost of production. I'd like to work through how this economic cost of production has been produced. This graph has long-term lease rates on the vertical axis. These lease rates are calculated as a percent of total farm value. The opportunity cost for an investment in dairy land has been based on these long-term lease rates for farmland. This is demonstrably more relevant than basing it on interest rates, as I will show you. You also see some potential anomalies in this graph. For instance, Argentina is one of the most risky countries in the world to invest in, and yet its lease rates for land in this graph are lower than anywhere else but the US. This graph has the risk-free interest rate on the vertical axis. This is based on a 5-year rolling average of the 10-year bond rate for each country, or where this was not available, for the nearest approximation of this. The opportunity cost of capital for livestock, vehicles, and machinery has been based on a 2% premium to this risk-free interest rate. If I now plot the lease rate used for land opportunity cost with dashed lines against the interest rate used for the opportunity cost on livestock, vehicles, and machinery with solid lines, you can see how these vary. This demonstrates how the market confirms that the real opportunity cost for land is the value at which it can be leased long term. Before we look at the impact of these varying opportunity cost return rates, I'd like to review the value of assets per cow against which these rates are being calculated. This graph has the value of total farm assets invested per cow on the vertical axis. South Africa has dramatically less value invested per cow, with this being aided by the increase in stocking rate per hectare over the last 20 years, meaning there are more cows to effectively carry the value of each hectare of land. When trend lines are added, including utilising quadratic fits to accommodate the steep rise in asset values running up to the GFC in particular, South Africa's competitive advantage is further highlighted. Even though there has been very significant appreciation in land values in South Africa over the last 17 years, due to the increase in stocking rate, the country's advantage has not been eroded. So based on the opportunity cost return rates and the value of assets employed, this graph outlines the opportunity cost of capital in US cents per litre of energy-corrected milk for each of the countries. This highlights how New Zealand bid up the value of assets, especially land, over the period 2003 to 2008, as it had been doing for some years before that. The New Zealand opportunity cost of capital peaked at around 15 US cents per litre in 2008, and this did significantly erode New Zealand's advantage in accounting cost of production. The US is in the strongest position with regards opportunity cost of capital, with this being less than 5 cents per litre since 2011. When trend lines are added, including quadratic trend lines for some countries, as these more correctly represent the impact of land value changes running up to and then following the GFC, the trends become clearer. The US is in the strongest position. New Zealand's position has been improving, and South Africa remains in a competitive position despite high interest and lease rates. So again, this slide outlines the economic cost of production for all the countries. The most notable feature is that all the countries are quite similar, which is what should be expected given the value for economic cost of production will coalesce around the price of milk. This graph does have a lot of similarity to the milk price graph from earlier in my presentation. Another related feature is more evident when I add the accounting cost of production graph. Although the US does have a significantly higher accounting cost of production than all the other countries due to its feedlot production system, its comparatively low cost of capital allows it to narrow the gap for the more complete economic cost of production. When the trend lines are added, South Africa's excellent position is further highlighted, including how the country has moved from having the second highest cost to the lowest economic cost of production over this period. New Zealand is also in a strong position, progressively improving its performance over the last 17 years. So if cost of production is at the heart of how dairy industries perform, how do the countries compare in the area of pasture harvest? In this graph, Australia, or Victoria in yellow, averages around 8 tonne dry matter per hectare, although pasture harvest in Australia ranges enormously from over 10 tonne per hectare in Tasmania to between 5 and 10 tonne per hectare in other regions. New Zealand in black has the highest level of pasture harvest, and South Africa in green has done an impressive job of closing the gap with New Zealand. Both countries have a huge natural advantage in pasture production compared to the other countries. New Zealand largely without the need or cost of irrigation, and South Africa with the addition of irrigation. However, Argentina and Uruguay have a significant disadvantage compared to Australia and the other countries. You will hopefully remember from the profit graphs that in the early years highlighted in red, Australia, Argentina, and Uruguay all had higher profitability than New Zealand. I hope you can also remember that Uruguay and Argentina had a lower cost of production than New Zealand in this early period. So the absolute level of pasture harvest does not explain any of the loss in profitability or loss in competitiveness over time compared to New Zealand for Australia, Argentina, or Uruguay. But South Africa's increase in pasture harvest over time does underpin your improvements in profitability and cost of production. Once trend lines are added, the changes in pasture harvest over the last 17 years is clearer. New Zealand in black has not improved its position compared to any of the other countries over this period. What is also evident is that South Africa's rapid improvement in pasture harvest occurred over the period through to around 2012. That is the dominant factor that has driven improvements in profitability in South Africa over the last 20 years. Since that time, any further improvements have been minor at best. So for South Africa, the major opportunity to improve profitability through increasing pasture harvest is now done and dusted. For many, if not most farmers, this opportunity was closed out about 8 years ago, and you are now well and truly into the red zone. It begs the question, where to from here to secure improvements in profitability, or is it simply a case of holding steady and managing the existing business well? This graph of stocking rate largely mirrors the pasture harvest graph, with the South African stocking rate increasing steeply to drive the increase in pasture harvest. When trend lines are added, the match with pasture harvest is accentuated. The two other countries with increasing stocking rate, albeit with smaller increases, are Australia and Argentina. For these two countries, the stocking rate increase has not been matched by increases to pasture harvest, which has resulted in the percentage of pasture in the cow's diet declining and eroded their profitability. This graph of milk production per cow in litres of energy-corrected milk, with the results being industry averages and not benchmark averages. As a result, many of the numbers may appear lower than you might have assumed. The United States in red does look very impressive, with production increasing year on year at a consistent and rapid rate. I guess this graph is one of the reasons why so many farmers in pasture-based countries might think they should adopt some production practices from the US. However, as this graph from my first webinar highlights, milk production per cow does not positively correlate with profit on pasture-based dairy farms, although very low or very high levels of milk production per cow are likely to reduce profit. This graph is milk production per cow on the horizontal axis and plots its impact on return on capital or profit on the vertical axis. This is the same graph of milk production per cow, though now the trend lines are added. The 5 other countries, excluding the US, are all delivering regular increases in milk production per cow, with not a lot to split them, though South Africa would appear to have the lowest rate of improvement over the last 17 years. I'm not sure if this is a good result due to the industry-wide focus on pasture harvest, or a bad result due to cow breeding policies still biased towards US type rather than pasture type cows. Now, before any of you get too overconfident how South Africa compares with New Zealand, in regards to pasture harvest, it could be important to appreciate the impact of this graph of pasture cost per tonne dry matter. New Zealand has a huge advantage over all the other countries, which potentially underscores a competitive advantage that underpins their industry performance. So although South Africa has significantly closed the gap in pasture harvest with New Zealand, the much higher irrigation and nitrogen costs in South Africa still result in the gap in pasture cost being as wide as ever. New Zealand also has the advantage of a more southerly latitude that ensures their pasture has higher energy density and lower fibre content. However, when the trend lines are added to the pasture cost graph, it is clear that South Africa has improved its position against all the other countries. So where else can we look to investigate how South Africa is performing and where the opportunities are to further improve business performance? This table breaks total expenses per litre down into total feed costs, including pasture, versus labour costs, versus all other costs, and includes a calculation of the percentage of total expenses for each of these cost centres. As the table confirms, the total cost of feed comprises around 40 to 60% of total costs for pasture-based farms and around 60 to 70% for feedlot farms. Total labour costs, including costs of management, is usually the second highest area of expense after total feed. This graph has labour cost per cow on the vertical axis. The largest portion of labour time is related to cow activities, which is why this ratio is important. South Africa has emerged as the country with the lowest labour cost per cow and by quite a wide margin. This graph has labour cost per litre on the vertical axis, which was the ratio included in the previous table. Again, South Africa has emerged as the country with the lowest labour cost per litre, with the US having the next lowest cost. So although the US has a very high labour cost per cow, their very high level of milk production per cow does bring the per litre cost down to a competitive level. These comparative levels of performance are more clearly evident when trend lines are added. South Africa retains a substantial competitive advantage in this area. So the labour component of total expenses is an area of real strength for South Africa, though this equally means it is not an area of relevance if the industry is seeking to significantly increase profitability. All the other costs, except feed and labour, comprise just 26% of total expenses on average in South Africa. There was also no single dominant cost centre within this group, so there was no opportunity to make a significant difference in total expenses or cost of production by focusing on these areas. So this means that if South African dairy farmers want to significantly improve profitability in the future, they need to look at the total feed cost per litre. In fact, for South Africa, feed costs comprise a higher percent of total expenses than for other pasture-based countries, with this being in the 60 to 65% range on average. There would appear to be just two ways to substantially reduce the cost of feed per litre. The first option would be to significantly and permanently reduce the cost of concentrates, forages, and pasture per tonne. There is no evidence to suggest that this is an option for most farmers. So the second option is to change the mix of feeds, reducing the feeding rates of the more costly ones and increasing the feeding rates of the less costly ones. At present, South Africa's total feed cost averages around 20 US cents per litre. New Zealand, on the other hand, has average feed costs of around 12 cents per litre, or approximately 40% lower feed costs. So the question relating to how South Africa might lower its feed cost per litre might be further paraphrased as how might South Africa or any other country have feed costs per litre more similar to New Zealand. This table might help with understanding the impact of different mixes of feeds on expenses per litre. The table includes the production and or purchase cost of pasture, concentrate, and forage, so silage, and then calculates the ratio of concentrate and forage cost to pasture cost. The ratio of concentrate cost and forage cost to pasture is the key here. Look at the scale of this for South Africa, where concentrates are on average 280% more expensive than pasture, or close to 4 times the cost of pasture. Forage costs are also significantly more expensive than pasture, although not to the same extent as concentrates. New Zealand's cost comparison between pasture and both concentrate and forage is even more extreme. So as more and more low-cost pasture is replaced with more expensive supplement in the cow's diet, the cost of production per litre is likely to increase. This graph plots changes in pasture as a percent of the total diet, with this ratio defining the production system. New Zealand stands out with its very high percent of pasture in the diet. Like farmers in other countries, New Zealand farmers do increase the use of supplements and push up their cost of production when milk price is high, but they reverse most, if not all of this, when milk price turns down. South Africa also stands out, though for the opposite reason, given its very low percent of pasture in the cow's diet. Once trend lines are included, it is evident that New Zealand has changed its production system little over the 17-year period, with pasture continuing to comprise over 75% of the diet. When the table of total change in pasture percent in the diet is added, it is further evident how little New Zealand has changed compared to all the other countries. All 4 of the other countries have large decreases in pasture as a percent of the diet, with Australia and Argentina having the largest decreases. And it is Argentina and Australia where the steepest increases in cost of production and loss of profitability have occurred. These changes have coincided with significant increases in the amount of concentrate fed per cow and the continuing breeding of larger US-type cows. South Africa starts the period with the lowest percent of pasture in the diet, and with the further 10% drop in pasture percent over this period, remains with the lowest percent of pasture in the group. It would appear that this is one of the significant weaknesses, or the significant weakness, within the South African dairy industry and the area of greatest potential opportunity. This graph outlines the cost of total feed per litre. The table outlines the costs that are included in this calculation. These costs include all concentrate, forage and silage and pasture costs, as well as all young stock rearing feed costs. New Zealand has easily the lowest cost of feed per litre of the group, although the US price of concentrates and forages per tonne are lower than almost all other countries in the world. Their total cost of feed per litre is much higher than for all other countries in the group. Once again, although this may be a sustainable position for the US given their high milk price, there is certainly a big warning for all other countries not to adopt the US production system and its focus on high levels of milk production per cow if you're exposed to internationally traded milk prices. So as pasture becomes a lower percentage of the diet, the average cost of feed increases per tonne. This increase in cost per tonne is of such a large quantum that it increases the cost of feed per litre, as this graph with trend lines added further emphasises. South Africa has improved its position compared to Australia, Argentina and Uruguay, as these 3 countries have all moved from having total feed costs similar to New Zealand at the start of the period to being much higher than New Zealand and closer to the US by the end. This improvement by South Africa will be largely due to the significant increase in pasture harvest in South Africa. However, if South Africa wants to reduce its cost of feed and close some of the gap with New Zealand, then new tactics are required. This graph is total operating expenses per litre on the vertical axis. Since 2009, New Zealand has had the lowest operating expenses per litre, and the United States has the highest expenses over the entire period. South Africa commences the period with operating expenses higher than all bar the US, but has progressively improved its performance to a level where its expenses are lower than all bar New Zealand. Trend lines further highlight the impressive performance of the South African dairy industry over this period. So what are the main strengths of South African dairy farm performance? Firstly, pasture harvest is now on average very high compared to most countries. And this has been the key driver in improving profitability in South Africa over the last 20 years. Secondly, labour costs per cow and per litre are very low compared to all other countries. Thirdly, cost of production per litre is comparatively low. As this graph of cost of production highlights, since 2012, South Africa has been very competitive with other countries. The fourth point is that South Africa has a comparatively low value of assets invested per cow, resulting in higher levels of return on capital compared to other countries at lower levels of profit per cow or per hectare. As this graph of total farm assets invested per cow highlights, South Africa has dramatically less value invested per cow compared to all other countries. The fifth point is the comparatively high level of profitability, particularly in regards to return on capital and profit per hectare. So what may be the weaknesses and potentially the areas where the industry could move its focus? Firstly, South Africa has a high cost of production farm system with a low percent of pasture in the diet. As this graph of pasture as percent of the cow's diet highlights, South Africa would not appear to be taking full advantage of the potential benefits from its high levels of pasture harvest, due to the feeding of high rates of concentrate in particular. On average, South African farmers are now feeding their cows around 60% of the diet as supplement. I'm going to try to highlight the comparative impacts of pasture harvest and production system on industry performance and profitability. This graph is of change in return on capital or profit over the 15 years from 2005-06 in South Africa, starting from a base of 1. This trend line suggests return on capital is now around 30% higher than at the start, notwithstanding the falling away in profitability in the last couple of years. Now I've added profit per hectare in US dollars in purple, with the trend describing an increase of around 180%. This has been underpinned or primarily driven by the improvements in pasture harvest over this period. Now I've added dairy land values per hectare in US dollars in green, with the trend being similar to that for profit per hectare. So the increase in land value over the last 15 years has been almost entirely supported by improvements in land productivity and profitability. I've now added total asset value per hectare in US dollars in orange, with livestock being the main addition, though also the value of vehicles and machinery. The trend is still similar to that for land value per hectare and profit per hectare. Now let's see what happens when we add profit per cow. So profit per cow in US dollars is in red, and you can see how much lower or poorer the result has been than with profit per hectare. Increases in pasture harvest have helped to improve profit per cow over this period. But this much lower trend and improvement highlights how the cow production system has been holding profitability back. This is where the choice of production systems I described in my first webinar is an emerging weakness, with the majority of South Africans reducing pasture as percent of the diet and increasing concentrate fed per cow in particular, often chasing higher milk production per cow from US type genetics. And when cow value per head in US dollars in brown is added, the trend is slightly negative over the last 15 years. Until I analysed this data, it had confused me as to why cow prices were so low in South Africa compared to most other countries, and why they'd remained so low over such a lengthy period. Not surprisingly, the market would appear to be giving the correct signals. Cows are not that profitable in South Africa, and this has effectively been hidden from view by the terrific gains that were being made in pasture productivity. So it is the high cost of production farm system that is the Achilles heel of the South African dairy industry. It is now the major factor limiting further improvement in the industry's international competitiveness. Conversely, it could be described as the biggest single opportunity for the industry to improve profitability. The second point is more in the nature of an observation, and that much of the industry does not appear to be recognizing that the gains from increasing pasture harvest have now been largely realized. South Africa is now well and truly in the red zone, so little further improvement in pasture harvest is likely. though there does not appear to be a clear strategy on where to from here if the industry wants to continue to improve its financial performance over the next 10 years. And the third point is that farmers should now be expecting to receive lower milk prices than they received historically, though this may not yet be factored into many farmers' thought processes and plans. As these graphs highlight, South African milk prices appear to be stabilising at internationally traded values with little or no premium for domestic supply. This is a significant change, and the additional pressure from comparatively lower milk prices is likely to require the adoption of lower cost of production systems at some point. Question may be when. However, when both the strengths and weaknesses are considered, there is absolutely no doubt that South Africa already has everything in place to be a competitive exporter of milk products. This graph of cost of production confirms that South Africa can outcompete all these other countries with the exception of New Zealand. Milk can be profitably produced for a lower cost in South Africa, and the track record of doing this now covers a period of almost a decade. And this is before farmers here hopefully address their Achilles heel of a comparatively high cost production system. As I will show in my third webinar, the present cost of production could be reduced significantly. So let's now look at the possible steps for South Africa to take to become a significant exporter of milk. Firstly, it takes time to develop and then sustain export markets. Most customers want to be supplied significant volumes to make the relationship worthwhile. They will normally want to receive the product all year round. Secondly, the product needs to be supplied at a competitive price. There is no point in South African farmers producing milk at internationally competitive milk prices and then have a milk processor unable to compete internationally on processing cost. This does mean that any export processing facility needs to be of sufficient scale to gain the economies of scale that the competitors in other countries have access to. So processing facilities would require sufficient milk daily and receive this milk all year round and not just be utilised to dispose of the surpluses. What might this mean? This is a graphic representation of the present South African national milk production curve. It is set at 1 for the lowest month of June, with the peak month of October receiving 1.4 times the volume of June's milk production, on average or around 40% more milk. I've now split this present volume into a possible representation of a domestic portion in black, where this rises by say 10% for the peak spring and summer months, but where no month is more than 10% above the lowest months. The light blue line represents the nominal surplus, with 6 months of nil potential export volumes, which is not a realistic base from which to develop an export industry. I appreciate this example may not have the milk production split absolutely correct, although hopefully it is good enough to demonstrate how a sustainable export industry could be developed. Now I've added 10% additional milk to the present market and smoothed the domestic supply volumes in dark blue. However, I've retained the same 10% increase in domestic spring and summer volumes compared to the lowest supply months. So the new export volume is the dark green line near the bottom of the graph. This does provide year-round volumes for export, but I believe that 2 to 4 times larger volumes in August to December compared to February to June would mean this would still not provide the basis for a sustainable export industry. Maybe this next change would be more realistic. Now I've added 20% additional milk to the present market. The new export volume is the lighter, brighter green line. This would provide significant year-round volumes for export and should allow the peak spring volumes to be exported. Possibly this might also allow farmers to increase their seasonal milk supply in spring, which could help these farmers lower their cost of production. The additional light green dashed line represents peak milk of around 40% higher volume than for the lowest production months. This final brown line represents what this total milk production curve would then look like. If the industry was to pursue a future as an exporting country, then it would take over 10 years in all probability to deliver these additional volumes. The present average annual growth of 3.6%, which has been required to satisfy the domestic market, would need to lift to over 5% for an extended period. This is a significant hurdle. So presumably the investors or owners of an export processing facility might require financial support to bridge the gap between export and domestic market milk prices. Historically, the domestic price of milk has been significantly higher than the international price. But as we had seen in my earlier slides, this is no longer the case. Since 2011, any premium for domestic milk supply has disappeared, and there are sound reasons to presume these premiums have gone for good. However, support will still be required for a defined period, potentially for 10 to 15 years, while national milk production grows to the extent required to produce sufficient volume all year round to underpin an internationally competitive export industry. In my view, this would be a really exciting prospect for the dairy industry to become a significant milk exporter and earner of foreign exchange. In addition, this would result in more employment within South Africa, both on dairy farms as well as in the processing industry. So might industry-wide and even government support be possible? Interesting and final question as that brings my presentation to an end. Thank you.